Everything you've been told about why the Federal Reserve raises or cuts interest rates is a carefully crafted narrative. They tell you it's about fighting inflation. They tell you it's about managing unemployment. But I've always said that those are just convenient excuses. Fed's decisions are driven by a much more fundamental, much more urgent factor: its ability to sell U.S. Treasury bonds. In other words, its ability to fund U.S. government debt. Don't believe me? Just look at what happened last year. Fed made some small moves towards easing rates. The market immediately reacted. The dollar weakened, and global buyers became reluctant to lend money to the U.S. bond sales stalled. What did the Fed do? It quickly abandoned any talk of further rate cuts and went right back to their tough stance. At the time, they said it was because inflation was still too high, aiming for a 2% target. But fast forward to today, inflation is still well above that target. New tariffs are adding even more price pressure. And yet suddenly the Fed is signaling that a rate cut might be necessary. Why the change of heart? Because they've admitted the unemployment situation is likely far worse than the official data shows. This tells you everything. They will tolerate high inflation. They will tolerate a weaker dollar. But the one thing they cannot tolerate is a world that refuses to buy their debt. Their primary motive isn't protecting your purchasing power. It's protecting their ability to borrow. Now that you know their real game, you can start to predict their moves. How to play this game. Follow us or subscribe to this channel.